In recent meetings of the Federal Reserve's Open Market Committee, the Fed chairman agreed that it was in the best interest of the U.S. economy to sustain their zero interest rate policy. However, with that said, they also stated that while reluctant to do so too soon, they were openly considering seeing rates rise as the economy proceeds through the next months. Well, batten down the hatches. This will be interesting as we together see if the Federal Reserve can manage this unwinding of the multi-trillion-dollar stimulus that's been applied. The first thing to understand is what will cause the Fed to raise rates. The Federal Reserve has what's known as a dual mandate: to preserve economic growth with low inflation and to sustain full employment, two mandates that are often at odds with each other. As the U.S. economy came through the Great Recession, then Chairman Ben Bernanke made a very persuasive argument that in order to prevent another Great Depression, the central banks, both in the U.S. and abroad, needed to engage in stimulus by providing exceptional amounts of new liquidity, yep, that's new money, into the markets. Since 2009, the Federal Reserve has expanded its balance sheet, in other words, created money, to the tune of about $3.3 trillion new dollars. They did this by buying U.S. government bonds as well as acquiring some of the less desirable assets from some major financial institutions. It appears, at least in the near term, that this strategy has worked. We've had poor but moderate economic growth, unemployment coming down, at least as it's reported, and we've not seen inflation raging away. Now, however, even the Fed is accepting that this stimulus cannot go on forever. The second and third quarters of 2014 reported relatively robust growth, which leads the Fed governors to the conclusion that more stimulus may not be necessary. But to overreact to this seemingly good news and raise interest rates too soon could in fact jeopardize the fragile economy that's establishing. In addition, like all of us, they see that the European economy and the Far Eastern economies, most importantly China, are beginning to slow down. So the net conclusion is to stop buying more securities, but not to raise interest rates yet. Now, their direct statements say, yes, rates will go up, but perhaps maybe next summer. But the implication is that rates may go up sooner. So with all that understood, what does this mean in the real world to you and to me? Number one, the enormous run-up in the stock market that has been fueled by the loose money policy of the Fed could quickly come to an end. As interest rates rise, making fixed income investments more attractive, stocks will lose some of their attractiveness. So you need to be very closely monitoring your stock investments. Well, what else is new? You should be doing that anyway. But this time, start to think about how you can implement a sell discipline that will prevent you from giving back all of the wonderful gains you've enjoyed. This could be as simple as a stop loss on your stocks, or simply accepting that if things drop more than a certain percentage, you're out. If you haven't pre-thought this and planned for it, you will get hurt. So do that today. Secondly, if you're looking to buy a home, now's a pretty good time to do it. As rates rise, so will mortgage rates. Duh. And that's going to cost you lifestyle. A $200,000 mortgage at 2.5% has a payment of around $775 a month. At an increased interest rate to 4.5%, an equivalent payment would only support a $150,000 mortgage. Same payment, $50,000 less house. So if you can, lock this in now. And finally, watch your bonds. As you know, when rates rise, preferred stocks and bonds decline as their current yields will become less competitive with new yields. Now, you don't have to experience a capital loss, of course. If you own bonds, just hold them to their maturity. But if you need liquidity or you're buying bonds in a mutual fund environment, be aware that when the Fed starts to raise rates, those bonds will decline. Now, you can hedge this in the ETF world, but that is a topic for another day. Well, happy investing, and let's all pray that the Fed does in fact have the wisdom of Solomon.